So this is a Chapter 5 practice problem. It's the problem in your set relating to Ken. All right. So I'll go through it item by item. And the whole purpose of this problem is to find Ken's gross income given all of this other information. Okay. So we're going to look at each item and we're going to decide if it's included in gross income, and if it is included in gross income, to what extent it's included in gross income, and then we'll come up with a total number at the end. All right, so here we go. So I'm going to have to resize and move things around as we work through this. Okay, so part A says Ken won $1,200 in an illegal game of poker. The game was played in Utah, where gambling is illegal. Okay, so what do we know? Well, we know that gross income includes income from all sources, whether it's illegal or legal. So is that $1,200 included in Ken's gross income? It absolutely is. So he has $1,200 of taxable income as a result of those illegal activities. All right. Part B says that Ken sold 1,000 shares of stock for $32 a share. He inherited the stock 2 years ago. His tax basis in the stock was $31 per share. Okay, so I'm going to move down here below and we'll work through item B. Okay, so what do we know? We know that return of capital is not taxed, but gain is. So what do we need to look at? We need to look at our sales price minus the basis, and that is going to be equal to our gain or loss. All right, so now we just need to figure out the amounts for those pieces. All right, so I'm going to make this a little bit bigger. So he sold 1,000 shares at $32 a share. So 32 times 1,000 is going to be 32,000. So that's his sales price. His basis, we're told, is $31 a share, and he has 1,000 shares. So his basis is 31 times 1,000. That's 31,000. And so what does he have as a result? So he has a gain of $1,000. Okay? Now, we also know that he inherited that stock 2 years ago. So this is going to be a long-term capital gain. We're not asked that in the question, but I just thought we should talk about that as well. All right, so I'm going to resize. And so he has $1,000 of gross income from that. Okay, so item C says he received $25,000 from an annuity he purchased 8 years ago. He purchased the annuity to be paid annually for 20 years, and he paid $210,000 for this annuity. Okay. So again, I'm going to move down here and walk through item C. Okay. Now, when we're talking about annuities, so remember that an annuity is part return of capital and part income. So an annuity has two parts: return of capital and income. All right. So there is what's called the annuity exclusion ratio. Okay, and that annuity exclusion ratio is your original investment over the expected value of the annuity. Okay, so let's put a value to each of those pieces. Okay, so what do we know about this annuity? We know that we're told that he paid $210,000 for this annuity. So that was his original investment. That's what he paid for the thing. And then our expected value of the annuity we can find. All right, so let's look back at the verbiage here. And we're told that he receives payments of $25,000 from the annuity, and he's expecting to get those for 20 years. All right, so our expected value of the annuity is the life of that annuity times his payment per year. So the expected value of the annuity is 20 times 25,000. Okay. So that's going to give us 210,000 over 500,000. Okay. Now, remember that this is the annuity exclusion ratio. So we're going to divide that and find our percentage. And so our percentage is, or I should say our ratio could be 0.42. Okay, so what does that 0.42 tell us? That tells us the amount of each payment that's excluded from income. All right, so 0.42 is the amount of each payment that is excluded from income. All right. So what do we do with that? Well, he received a payment. So payment times exclusion ratio equals excluded amount. All right. So our payment was 25,000. Our exclusion ratio is 0.42. And so if we take 0.42 times 25,000, we get 10,500. So this 10,500 is the amount of each payment that's excluded. So we take 25,000 minus 10,500. Oops, 25 minus 10,500. And we get 14,500. So this is included in gross income. All right, so he has $14,500 that is included in his gross income because that's the income portion of his annuity payments. So we're going to write that up here. Okay. All right, so that takes us to part D. All right. And so part D says Ken received $13,000 in disability benefits for the year. He purchased the disability insurance policy last year. Okay, so let's move down here and let's talk about part D and disability payments. Okay, so disability payments. Sometimes disability payments are included in your gross income. Sometimes they are not included in your income. So let's talk about the difference between those two scenarios. Okay, so disability payments are included in gross income. All right, so they are included in gross income if all right, so disability payments are included in an employee's gross income if the employer pays for the policy and the value of that policy is not taxable to the employee. Okay, so for example, if in your tax exempt fringe benefits you have a disability policy, whatever portion of that is paid for by your employer and is provided for you tax-free at that time, those payments will then be included in your gross income. Okay. Disability payments are not disability payments are not included in gross income if okay, so two different scenarios. The disability payments will not be included in gross income if the policy is purchased by the employee. Okay, so if you go out and purchase a disability policy and then you get hurt and can't work, those payments that are made to you then out of that policy are not taxable. So think about all the Aflac commercials where you have the duck and they're handing cash to the person who paid for this disability policy. Okay, those payments would not be taxable. Also, if your employer provides disability coverage, but then that's included in your salary, that's a taxable benefit to you, then if you end up with disability payments out of that policy, those payments at the time are not taxable because you were already taxed on the value of that policy. Okay, so you don't get double taxed, but you do have to pay tax or have some kind of economic stake in that policy. Okay, whether that be upfront from a purchase perspective or when you receive payouts. All right, so given all of that information, let's look back at Ken's situation. And it says that Ken received $13,000 in disability benefits for the year. He purchased the disability insurance policy last year. All right, so he purchased the policy, so he does not have to include those payments in his gross income. So the gross income effect of that policy is 0. All right, so now Ken is a lifelong learner, and he has decided to go back to school to learn about European history. He's received a $500 cash scholarship to attend school. He used $300 to pay for his books and tuition, and he applied the rest toward a new car payment. All right, so here's the deal with scholarships. All right, as long as scholarships are paying for expenses that are directly related to your university studies. So tuition, books, all right, computers that are required by whatever program you're in at school, okay? This does not include room and board. Those amounts are not included in gross income. If, however, you use a portion of a scholarship for living expenses, those amounts are included in your gross income. So he received a $500 scholarship. He used $300 of it for his books, but that $200 that he used to make a car payment is going to be included in his gross income. Okay, so he would have $200 of gross income as a result of that. All right, so let's look at F. So Ken's son, Mike, instructs his employer to make half of his final paycheck payable to Ken as a gift from Mike to Ken, okay? And the amount is $1,100. So the question is, does Ken have gross income as a result of this gift from Mike? And the answer is no, all right? And so let's come down here. And this is part F. So Ken receives a gift from Mike, all right? The person receiving the gift does not pay tax on the gift. If there were to be any tax implications of that gift, those taxes are paid by the person who gives the gift, not the person receiving the gift. Okay? So Ken does not have income. Also, remember that Mike cannot tell his employer, hey, give Ken a gift and now I don't have to pay taxes, right? Because assignment of income matters. So Ken does not have gross income as a result of this. So we get to put a 0 by that one. All right. All right, we're going to skip G for just a minute because we're going to go back down below and work on G. But H says Ken received $30,000 of interest from corporate bonds and money market accounts. Okay. That $30,000 is absolutely going to be included in his gross income, and that's going to be taxed at ordinary rates. It's ordinary income, okay? Interest from corporate bonds and money market accounts, bank accounts, certificates of deposit, CDs. That's all ordinary income, okay? So even though it's investment income, it's taxed at ordinary rates. So he does absolutely have to recognize $30,000 of income as a result of that interest. Okay. All right. So now let's look at G. Okay. And I wanted to save G for the last because we're going to have some work to do with that one. So Ken received a $610 refund of the $3,600 in state income taxes his employer withheld from his pay last year. He claimed the $12,450 itemized deductions last year, and the standard deduction for a single filer was $12,400. Okay, so we've got all that information. If you need to reread the item G information, I recommend you do that. I'm going to scroll down and we'll work through item G now. Okay. All right. So I'm going to change colors and we're going to work on item G. Okay. So item G has to do with what's called the tax benefit rule. Okay. The tax benefit rule says that if you receive a deduction for it in one tax year and then get a refund related to that deductible item the next year, you're going to have some income. All right. So I'm going to write that down. Okay, so if an item is deducted in one tax year and then later refunded, it results in income in the year that it's refunded. Okay, so this is very common with state taxes. It can also be common with medical expenses. Okay, but most of the examples you're going to see are going to be in state tax issues. Why? Because state taxes are withheld just like federal taxes, right? And so depending on your tax planning situation, lots of times you end up with a state tax refund as a result of your withholding amount. And that refund comes after you file your taxes, which of course is in the next year, the next calendar year, after that tax was incurred. Okay, so let's look at what we've got. Okay, so if we look at, so we're going to call, well, let's put actual years in here. So in 2020, okay, what happened? So in 2020, he had withholdings of state taxes equal to $3,600. Okay. What else did he do? So he itemized deductions on federal taxes. And so he had $12,450 of itemized deductions. Okay. 2021, what happens? Well, in 2021, he gets a refund related to those state income taxes of $610. Okay, so the question is, in 2021, how much, oops, okay, so in 2021, he has this refund related to state income taxes of $610. So the question is, in 2021, how much income does Ken realize as a result of that state tax refund? All right, so we've kind of got all of the information around this situation set up. So what I like to do when I solve these problems is look at what they did versus what they should have done. Okay, so I'm going to change colors here. All right. In 2020, what did Ken do? What did he do? Okay. Well, he itemized, right? Okay. So he had a $12,450 deduction. Okay. If Ken had perfect knowledge, Ken should have, okay, what should Ken have done? Okay, well, let's look back at what Ken did. All right, so Ken has a $12,450 itemized deduction. Okay, within that deduction are $3,600 of state taxes that were withheld, okay? But he ended up with a refund, right? So what does that mean? So since Ken had a refund, he should have only deducted $3,600 minus that refund amount. Okay? Because he was over withheld, right? And he didn't know this. It's not like he did something wrong. He didn't do anything wrong. He just didn't have perfect information at the time. And that's okay. So what he should have done is he should have deducted only deducted $2,990 for state taxes. Okay? So what would that have done? Okay? So as it was, he had $12,450 of itemized deductions, but that included that $3,600 of state taxes. So if he only had $2,990 of state taxes, his itemized would have only been the amount that they gave us minus his refund amount, right? Because we know he overpaid his state taxes because he got a refund. So his itemized taxes should have been, if he would have had perfect information and perfect tax planning, his itemized deductions would have only been $11,848. Okay? So if his itemized deductions were only that amount, what would he have done? Okay? He would have taken the standard deduction, because we're told that the standard deduction was $12,400. All right. And so if he had perfectly planned for his state taxes, he would have only had this amount of itemized deductions, which is less than the standard deduction. So he would have taken the standard deduction. So what is the difference between what he did, he itemized, and what he should have done? He should have taken the standard deduction. Okay? So the difference between those two things is $50. All right? So what that means is Ken has $50 in income as a result of that $610 refund. Because what that $610 refund would have done is would have made him take the standard deduction instead of itemize. Okay? So as a result then, we've got to scroll all the way back up here. He has $50 of income from that $610 refund. All right. So if we add up all of those things, all of those items, what does that give us from a gross income perspective? If we add all of those things up, that gives us a gross income of $46,950. Okay. So that is the Ken problem.